If oil had stayed above $100 per barrel, your inflation would have likely surged again. Fuel cost would rise, transportation cost would rise, and central banks might even delay the interest rate cut. But suddenly, oil prices crashed. So, what did the market suddenly realize? Because the reason oil fell has nothing to do with the demand. And once you understand it, you will see how global markets actually move. And the answer begins with a tiny shipping route most people have never heard of, a place that controls nearly one-fifth of the world's oil supply. When geopolitical tensions rise in the Middle East, oil markets react instantly, not because supply has already changed, but because traders fear that supply might change soon. Oil traders constantly price in the risk, and when the risk involves global energy supply, prices can move extremely fast. The biggest fear this time was disruption in the Strait of Hormuz. The Strait of Hormuz is one of the most critical oil routes in the world. Roughly 20% of the global oil shipments pass through this narrow channel. If tankers stop moving here, global oil supply could drop overnight. That possibility alone is enough to trigger the panic buying. And that is exactly what happened here. Traders rushed to buy the oil contracts and prices surged above $100 per barrel. But then something strange happened. None of the things traders feared actually occurred. Oil tankers were still moving, exports were still flowing, and global oil supply had actually not been disrupted, which meant the surge above $100 wasn't driven by a real shortage. It was driven mostly by fear and speculation. Once traders realized that, many began closing their positions. And when large traders start exiting the oil positions, prices can fall very quickly. Oil markets are extremely sensitive to the expectations. Prices often move based on what traders think might happen, not just what has already happened. This means oil prices can spike rapidly during geopolitical risk and then fall just as quickly when those fears fade. That is exactly why oil suddenly dropped below $100 again. Oil prices influence far more than energy markets. They affect the inflation, transportation costs, corporate profits, central bank policy, and global stock markets. One sharp move in oil can ripple through the entire economy. That's why investors across the world watch the oil markets very closely. Because sometimes the biggest moves in financial markets are not driven by fundamentals, they are driven by expectations, fear, and uncertainty. If you want to understand the forces that move the global markets, subscribe to the channel because we break down the hidden mechanisms behind the market movements.